Good morning. Brian Hale with Mortgage Advisory Partners. It's Monday, April 1st, coming to you from my lake house in Texas. For those of you who celebrate Easter, I hope you had a great Easter yesterday and got to spend some time with your family. This week's newsletter, which the link is above here in this post, brings you not a lot of information from last week, to be honest. It was a very tame week with only 3.5 trading days to the week. So in many ways, it kind of turned out to like a 9-day holiday for most bond traders. There was very limited data that came out, nothing that really moved the market. The 10-year Treasury ended the week about where it started, and so not a lot of moves. The next 2 weeks, however, is going to be chock full of new data, starting with the JOLTS jobs report, which comes out, I think, on Tuesday of this week. Expected to be about 8.79 million, down slightly from the prior period. The March ADP jobs report comes out on Wednesday. Expected to be about 130,000 in terms of new jobs on the private sector jobs, compared to 140,000 last month. Thursday, we'll get the jobless claims report, which is also supposed to be up to about 214,000 new claims for unemployment, as compared to 210,000, so about flat over the last period. But the big number is Friday's non-farm jobs payroll report, which is expected to be at about 200,000 compared to 275,000 in the last report. And that's really the number that's been moving the markets over the last couple of months. In addition to that, on Friday, we'll get the unemployment report, which is expected to be really flat at about 3.9%. This week's newsletter has some interesting charts in it, particularly around home sales, which you can see the just rapid decline that we've been experiencing with a slight uptick over the last period. And then in addition to that, it also talks about home prices. The most recent report shows annual appreciation in the housing sector at about 6.6%, which is arguably unsustainable. But that number, the 6.6 number, is really driven by an immense spike that we saw last June. And that number, the June number, last June's number, will come out of the report here in July. And I think that number is going to flatten out here a little bit over the balance of this year once that big spike number comes out of the data set that's driving the 6.6 annualized number here currently. In addition to that, we continue to see really tepid resale of homes. New home sales, newly constructed homes, continues to be very strong, driven to some degree by builder incentives with really low interest rates in the mid 4s and 5% range. And they're not really having any trouble selling homes and getting transactions done. And that gives us some kind of tip as to what kind of rate we need to see before resale homes, sales of existing homes really begin to pop. In my opinion, I've been saying this for some time. We need to see a 5 handle on a 30-year fixed, somewhere in the mid 5s, maybe upper 5s, even, who knows, low 5s would be outstanding. I think would finally give sellers an opportunity to list their homes and buy another home. So as always, contained in this post is a link to subscribe to the newsletter. If you subscribe, you would have gotten the newsletter last Friday. With everybody who subscribed, subscriptions continue to be very strong coming in, and I appreciate everybody who has subscribed to the newsletter. We appreciate your feedback. Don't ever hesitate giving us some. As I always tell people, I don't actually write the newsletter. I publish the newsletter. I did some research to try to find the right newsletter for particularly originators, sales managers, branch managers, area managers in the mortgage business. But when I look down the list of subscribers, we have CEOs, presidents, heads of capital markets, folks who run broker-dealer operations. And so I think a number of people from all over the industry continue to find value in the weekly newsletter. So I encourage you to read through it weekly. We publish it here publicly on Monday mornings. And if you're a subscriber, you'll get it on, again, the previous Friday. It's really intended to help you prepare yourself to deal with your clients and your customers over the weekend and into the following week so that you feel like you're prepared. In addition, over the last couple of weeks, I've mentioned, continue to watch this space for some exciting announcements coming here soon. Last week, I shot a couple of videos to announce what we're going to announce here in this space. I'm really personally dedicated to try to help originators, branch managers, sales managers, areas, regionals, and others in our industry and help make them more prepared to deal with their consumers, give them ideas, tips, understanding of what's going on in the marketplace. And so we'll be announcing something here very soon, so continue to watch this space. And with that said, I wish you all a really great week. Be prepared. Again, the jobs report is going to come out on Friday, April 5th. And then we're going to see CPI, the other big number. It's really these first 2 weeks of each month really seem to matter in terms of moving the rates. So we'll see the jobs report come out very early on Friday morning, East Coast time. And then the following Wednesday on the 10th, we're going to see CPI, the Consumer Price Index, come out as well. So I want you to pay attention to that number. Those two numbers will likely really set the tone, certainly for the balance of this month and maybe for the next couple of months. If we see continued improvement in inflation, if we see any decrease in new jobs creation, those will both be very positive for the market, very positive for interest rates. So again, have a great week. I look forward to talking to you again soon.